Okay, welcome everyone. Welcome to the Hurley Investments Market View Commentary for Monday, the 11th of April here on the 2022. First thing to tell you, yes, send it to me, Abraham. First thing to tell you, this is a shortened week because anyone know why this is a shortened week? Take a guess. What? There we go. There, perfect. Palm Friday. Could be Good Friday. The market is closed, which when I was taking a look just to verify and make sure, I was looking through our days off this year, and we didn't get New Year's off, Martin Luther King, Washington's birthday, Good Friday, Memorial Day. I completely forgot, or I didn't know. I don't know when we got Juneteenth, National Independence Day, but we now get a day off in June. Independence, Labor Day, Thanksgiving on November 24th is a half day, and we normally have the 25th off. And then Christmas Day we're going to observe on December 26th. So, love it, Abraham. So we have this Friday off for Good Friday. I don't know who put in Palm Friday in there. Yes, all one and the same. We actually have a day off on our market, which means any big selling that don't want to stay in over the weekend will occur Wednesday, Thursday. And obviously we get Friday off. So expect a Wednesday or most likely Thursday sell off to not be in the market over the long weekend. So let's start with a couple questions. Why might people not want to be in the market over a long weekend this weekend? Because that'll lead me to my next comment, but why, there you go. Leave it to our leave it to our British man, right? Russian forces realigning and new general in charge. So yes, that's one. Now, a couple of you said taxes due. So as we look at things, I'm going to make a couple points. The butcher about, I thought it was a butcher of Syria, which is probably Baghdad, right? Thank you for saying that. The butcher of Syria is now in charge for Russia. But a couple comments came up. Kevin, on Monday, you were bullish again, and on a, and I'm approximately on a 0.97 market, we were up 3.6%, which is correct. And then Tuesday, the market turned like 1.5%, and we were down like 2.5%. And on Wednesday, the market was down like 1.25%. And on Wednesday, we went to more protection on everything after adding some protection on Tuesday. And someone was a little surprised, and I'm a little curious, if you see your market change, what is your expectation of me? Because I just want to make sure we're on the same page here. If you see the market change, what is your expectation on me? Do something to protect my money. Love it, Maud. Make us money, no excuses. Bill Brandner. Ouch, that one hurts. You should be singing in the rain. Make sure our portfolios fit the correct trend. Mary, I love that one. William, you suck. Always be right no matter what. I find that one interesting. I'm not always going to be right no matter what. But yes, so please understand, if I say something on Monday night, Tuesday morning might change the thought process. And that's completely correct, right? So please understand, you have to be nimble. And I'm going to go so far as to say the only rule that you follow 100% of the time in the stock market is to try not to lose money. But in real life, yes, some things I say on Monday might change Tuesday morning, and they did. We started to add protection on Tuesday on certain stocks, and it was a kind of simple. In fact, to a certain degree, it was very simple. As we took a look at positions, all we did is say, hey, you know what? The S&P, well, I should get the S&P up. So all we did, just so it doesn't seem like, you know, some big rocket science type of thing, all we did is say, hey, you know what? The S&P started to come down. And we went, you know what? Looks like it might break the 200-day simple moving average, but it wasn't. On the flip side, on the NASDAQ, since we are more NASDAQ aligned because it's beat the S&P for a while, it was simple. We just took one look, 1, 2, 3, 4, 5, and this was our Monday, right? And Monday, it started to fall on an even number, right? A round number, not an even number, a round number. 1450 to the penny, boom. We started to protect on Tuesday. We started to protect on Wednesday. Yes, the NASDAQ and the S&P were up a little bit on Thursday. We were okay with it. Friday started to fall down. And so that's what we were looking at. We're like, okay, it looks like we hit a resistance, and we chose to be a little overprotective last week. No one really looks at the Dow, but obviously our Dow is already below, and when it couldn't hold it, we were obviously getting a protection on. But the S&P was the main one. The S&P was, we just took a look and we're like, you know what? Going bearish. And so we said, let's overprotect versus underprotect. And that's what we did. By the way, just as a heads up, let me tell you a little story about my weekend. On Saturday, a neighbor loaned my boys a couple motorcycles, and the younger one ran into the older one. We are glad to say no broken bones on the foot for the younger one, and the older one, no broken bones on the older one, who is here next to me tonight, Jared. And the younger one, we're going to call it a severe sprain, but we're having some some looking at the x-rays because it wasn't clear enough to tell if he hadn't broken a couple bones in his hand. So we'll get that figured out. But yes, I do need a collar motorcycle. I shouldn't have been on it in the first place. With that said, please understand something that said Monday, if we have different direction on Tuesday, we want to start to protect individual stocks. And some of that protection comes down to, I can't remember exactly what it was, but some of that protection came down to just looking at individual stocks and where they were at. Apple was coming off of those highs where we have a triple top at 76.76. We put protection on Tuesday. We're like, you know what? It's coming off of it. It's already come off it once before. We put protection on it. Boeing, easy to see. Hey, it hit the 50-day. We put protection on Boeing, wanting to make sure it was going to be in good shape. Baidu, we protected Baidu last Tuesday. Very simple to see. It came up to the 50-day simple move on Monday. On Tuesday, when it opened up below it, we put protection on Baidu. What we're doing is not rocket science. We're just letting the charts dictate what we're seeing. We might, boy, we really thought about it. We thought about it on Friday. We thought about it on Thursday. Do we take off that protection at 32? If we could, let me go ahead and switch this out so it's a little bit bigger chart for you guys to see. Boy, Keeve and I really spent our time looking at this. Talking about problems. Talking about what's really hard to make the decision. Touched it, should have went higher. Touched it and held it. Touched it and just fell below after being up all day. Opened up below it today, but came back. Talk about some serious frustration. Keith and I were like, do we give it a chance? Do we go for that bounce? Do we go for that bounce? Is it a triple bottom? Or do we be careful for the 102 that we were just at? And because of political news, we chose to be a little more protective on Baidu. But again, just going through our charts, and some of you are like, well, yesterday you said this. Yes, the next day we may change our mind. We may change our mind and we're going to think about, hey, why did you do that? It's funny because a question just asked, did I want to discuss Costco? That's our Boeing, Baidu. So Costco is C. That's the next one on the list, right? Some of you were thinking, Kevin, Costco, it's a profit maker. Why did you take Costco off up at 607 to 609 on Friday? Well, it hasn't held 600. It hasn't held any round number. 600, 500. Our previous experience said, you know what? Today is a day to get out of our leaps on Costco. Not to mention, we had a heck of a profit. So between $607 to $609, we were able to exit our profit on Costco. Thank goodness, because the thing has done nothing but from 612 fall down to 584. We're probably looking to get back into Costco around 570 or even maybe down around 560. But it is something that we would be looking to do to get an opportunity for Costco again using those leap long calls that are a stock replacement strategy. I'm just going to go through a couple more just so you can see what we're looking at. Disney protection back on. It was a pretty simple call on Disney. because again, it hit its 50-day and couldn't hold its pivot point. No brainer. Disney protection went right on. Pretty simple. Ford, we put protection back on Ford, and we have not quite taken it off. But again, very simple. Anytime you break that 200-day or the blue line, the 50-day simple moving average, big money has sell orders stacked up there. We were shocked 2 weeks ago. It didn't break it. So we took protection off on that next up day. We got it back on and we've seen it run down. It's a no-brainer for us doing nothing more than simple technical analysis. Facebook, same thing. This was a Wednesday one. Couldn't hold the 50-day, came down, protection went back on Facebook. I'm just going to do a couple more because it's pretty easy to see what we're talking about. Let's use, I think I just did Ford, so let's do Under Armour. That's a core holding. Let's spell the ticker symbol correctly, right? That would always be helpful. But Under Armour is one that we went back to protection on. That again, that was a Tuesday, or if not the week before, because it broke it and it was just heading down. Pretty simple to see. So I'm just going to point out, and I've done it a couple times, if you still aren't using simple level 1 or beginning trading knowledge, you are just gambling in the market. So yes, we still use the basic fundamentals, the basic sentimentals, the basic technicals. We're still using it on a constant basis to make up our decisions. Why were we a little easier to put protection on? We felt uncertain about Russia, and we knew nothing last week other than the expectation was that another wave, or they were regrouping. Technically, some things needed protection back on, so technically we put that protection back on. And in general, our stock market today was down 1.57 or 67. Let me take a quick check. I should have written that down, and I did not. Our stock market today was down just over 1.5%. That's the easiest thing to say, right? 1.69. And in general, we were down 0.97. So we're back to protecting and making up more on the downside than our stocks are losing. And again, if we do just a quick little position retake here, or retab, right? We had our protection back on Apple. It hasn't moved enough, but we're now making up just about half of the downward movement. Boeing, puts are on. Kind of interesting. The Boeing shares lost 187. Our puts made up 247. Pretty cool on that one. Bank of America down $2,957. Our puts made up 2,033, about 66% of the downward movement. So here we are having our protection back in place. Just give it a couple more days. It'll be making up more of the downward movement than it is right now. But let's see where we're at on Baidu. Baidu lost 27,000 today. Where's our protection at? Puts, where are our puts at? That's a pretty crappy day. Not only did our protection lost 2,000. let me take a quick look at Baidu. So this is where we take our notes to, this will be our discussion first thing tomorrow. Baidu lost $1.71 today. And those are not, here are our puts, excuse me, our puts are hidden right here. 2,700, our new puts at 139, only made up 4,000. So that's one that Keith and I are going over tomorrow and saying, hey, what's the catch? What are we not doing right here? Disney lost 23. Our puts also lost 647. So it's funny, once we start to see 2 or 3 on $1.22, what's my thought process? When we start to see something like this on our puts, can someone tell me what's happening? What's missing, or what's the problem here? And I'm going to write it in as we're going through it. What is the problem if protection also is losing money on a down day on the stock? There are a couple different answers, but what can you guys tell me? Because some of us have not been in the education. So what's the question? So actually it's just the opposite of that, Mod, but very true. Volatility decrease, right? Volatility increases the price. Volatility decrease, or what else could be the other answer? What could be the other answer? Wow, William, you're killing me today. You're getting all the hard answers. Greek catch-up, which is exactly correct. The Greeks, there's something in the Greeks. The interest rate or something along those lines that was changing during that day. Could be our interest rate hikes. It could be the beta. It could be the switch of losing a day and that the markets are closed on Friday. There's a Greek catch-up that you'll see those positions catch up or make that up tomorrow. It's just a Greek input catch-up is what it comes down to. Most likely it's going to be caused due to our day off. So they have to recalibrate the pricing and it comes a day later is all that is. All right, someone asked, Kevin, your list here, where do you get this from? And primarily, I've still got this from nothing more than, hey, you know what? Verizon on this one, it's 422 confirmed before the market opens. I usually will get this information from E-Trade. That's where I've put it in here. But there are numerous places you can get it from. You can get it from Schwab. Usually you get it from your broker. You can get it from briefing.com, earnings calendar, which you can get this one from Google. You can get it from Yahoo Finance. Kipling's, there's another one there. There's a bunch you can get it from, but wherever you get it from, you just want to check 2 or 3 sources. So even if you were to use the Yahoo Finance calendar, all you're going to do is search for, let's see which one we don't have right now. Boeing. Let's go to Boeing. All you're going to do is just write in the ticker symbol for Boeing. And it doesn't matter where you find it or research it, but you're going to go through and you're going to say earnings date. This one says April 27th, 2022. I would usually go to FinViz. FinViz has been my earnings, what I said, check just to make sure the earnings are correct. And then you just look into FinViz for their earnings. And the earnings date is April 27th, before the market opens. So primarily, I would be checking these, and I have not checked them, but I will check them before I post this tonight. But yes, I'm going to go ahead and I'm going to change this one to before the market opens, and I usually check it first in E-Trade, and then I head off to FinViz to verify it. And so that's how I come up with this list to know when they're earnings, and I usually want my protection on a little bit before, which will bring me to my next question you guys asked. Kevin, I've noticed that you always, so it's a rule, right? That you always roll your long puts to at the money before earnings, even if they are deep in the money and will make up 90% plus on the way down, which is correct, because let's face it, does anyone truly know what a stock's going to do prior to its earnings? What do you think? Well, yeah, I've got my son Jared whispering, no. He's been through this quite a bit. So Maud says no. Mary says no. ADP says implied volatility goes up. Very true. So I'm trying to, if it's deep in the money, I'm trying to book it for a profit, even if it means I'm going to pay a little bit more for a new one. But the reason why is, well, actually, I'm going to ask you guys, why do you think I roll that protection down to as close to at the money as I can get it? Why do you think I'd be doing that? Here we've got this higher number, so if it goes down, we might make up 90% down. Why would I give it that 50-50 shot or, 60-40 shot? And you are 100% correct. Yes, I want to make something if the stock heads back up. I would hate to have all this profit in the stock. It has earnings, it bounces up 10%. All that profit disappears and we have nothing to show for protecting it on the way down. Complete waste of money, complete waste of time. I want to book that profit. I might change it from making 90 cents on the dollar back down to 50 cents on the dollar, but I want to book that profit so that if it bounces higher, we can make something. Not only if it's 90%, you've got volatility crush or that surprise decrease, because we know if they're profitable or not for the quarter. The reason why, maybe you can call it a rule, but I will roll those long puts to at the money, especially if we have a huge or nice profit in it, is because I want to make something on the way up. Now, in 2008, I learned this. On our second run through earnings were pretty good and everything bounced higher. How horrible was it for me to learn in 2008? I've got all this money in these puts. The stock goes up 10% and I'm still down for the day because I've lost all the profit plus the worry or the volatility, the uncertainty in that stock. And the stock doesn't make as much as the protection lost. It was absolutely awful. It's also the same place I learned you don't put two sets of protection on an earnings event because it can really pop up and you could lose even more money. So it's kind of a simple explanation that we're going to book that profit. If the stock continues to go down, yes, I would have wished that I still had it on. But because you don't know, You don't want to put yourself in a position where you're going to lose 2 out of 3 times, right? If it goes back up, you lose. If it stays sideways, you lose. You'd only make money if it goes down by having that protection $5, $10, $15, $20 above where the stock is at. For that reason, we put it there in the middle so we can win if it goes up. We can make something on the way down, and we'll be okay. It's a neutral if it goes sideways. We'll only lose a little. So that's a great question on those of you that emailed that into me. That's the reason why I roll down those profits, is to book it so we can make something if the stock heads back up. And no, I don't have a good answer on, well, how often does it go back up? I mean, it's pretty simple. Historically, you have 2 good earnings because they're cyclical. You have 1 sideways earnings and you have 1 down earnings. And your 1 down earnings each year is more than twice of the up earnings movements 2 weeks before or 4 weeks after. So that's why we protect. We protect for that time period where it's that 6-week period where a stock is most likely to lose 10, 15% or more of its value. All right, let's see here. Briefing.com told us, don't expect earnings estimates trend to remain the market's friend. Basically, they're saying we're probably not going to see the best earnings guidance. And the short answer comes down to financials may have been hit with the war. Technology may be hit with chip shortage. We still have China, and I've got an article on it. China COVID, which might be slowing trade patterns. We still haven't caught up with our supply and demand. They call it a muddled outlook. And a muddled outlook is probably the best way to say nobody knows what the hell is going on. And so if you don't know what the hell is going on, the smart people aren't going to predict or not going to say anything. They're just going to say, you know what? We've got higher inflation. We have higher interest rates. We still have a war. We have slowdowns in China. We haven't caught up for supply and demand worldwide on numerous commodities. Yes, there's going to be a wheat shortage and a grain shortage for what Ukraine puts into it. There's going to be a lower GDP because of Russia. Boy, if you want me to come up with a reason, there are all kinds of reasons why we shouldn't do better. With that said, we just went through 3 weeks of a bear market bounce where the buy the dippers came back in, but we also lost that last week. And obviously, if you watch today, we were doing really good until that last 45 minutes and the market really fell away. So the buy the dippers are not back in play. Not only that, you're going to hear more about yield curve inversions. And I've got a simple answer for you on that one. And that comes all the way down to why Buffett's 90-10 allocation drubs the 60-40 portfolio. The 60-40 portfolio no longer works in reality, never worked as advertised, except briefly in the 1930 bonds, which were neither correlated nor safe. Buffett's not a believer in bonds. If you have a 60-40 portfolio, you really haven't got a percentage of return that's been worth anything. And you can't beat the market. If 40% of your portfolio is in bonds, you're literally trading for that 4.4% market crash, which used to be the average for not 4.4%. Every 4.4 years, you'd have a market crash where you'd go into bear market for 20%, but it would come roaring back. Well, that's changed significantly. Our market crashes have really only been 2000, 2008, 2010, we had a little pullback, And then our little, 2019-20, we had our stealth 20% pullback and it came roaring back in a month. So for the last 20 years, a 60-40 portfolio truly wasn't beating the market. And I wonder how many people complained to their money managers at that time. One of the reasons that we do is I've done so much studying on Baidu. I'm trying to take the relevant information for us. And to Keith's credit, Keith basically asked me, well, Kevin, and I thought this was quite interesting. Well, Kevin, if you had some new money and it's going to be all yours, right? Not clients. Where would you put it right now? Like Warren Buffett does. And so my question was right back to him. Well, Keith, how much are you willing to lose before our bear market turns bullish again? Right? And Keith's simple answer right now was, well, Warren Buffett always puts his money to work. He does. He always throws it in there. But there are a couple things Keith forgot to understand. If you got a couple billion you're going to get paid for the year, can you wait out a bear market run? Yes. And number two, Warren Buffett takes billions of dollars of losses on something like Wells Fargo, right? But will a tens of billions of dollar loss affect the way that Warren Buffett lives? Of course not. So it was quite interesting because it was easy to talk with Keith and say, hey, with all due respect, yes, the principles of how we judge companies are Warren Buffett, how we run portfolios are Warren Buffett-ish, because instead of bonds, we use the long put to act as insurance. The way that we add more shares like Warren Buffett does, but we do it with our put profits instead of typical dollar cost averaging. Yes, we have in the past used options like Warren Buffett uses warrants with the stock replacement strategy that we use the leap long call, but we're not Warren Buffett. And even though we've got some big money coming to us rather quickly here, we're still not Warren Buffett. So it gave Keith some pause to think, yeah, because you know what? We could go back down and test those lows and lose, 15%, which is another 9% from where we are right now. If we take a look at the S&P 500, if you were going to ask me where could the market go back down to, it's pretty simple. The numbers are sitting right there. First stop, 4,220 to 25. It's going to test these round numbers. Next stop, 4,150. The next stop below that, 4,100. I would not surprise me with a war happening in Russia again to come back and at least test that S1 4246 level, which is 160 points lower than where we're at right now. we just broke the 50-day. We almost did it, but if we see follow through tomorrow, we're going to add a couple extra contracts to all of the stock positions, just like we've done with Baidu this year and Ford this year and Facebook this year and Disney this year. We might just add a couple extra contracts so that we can make up more money on the way down than the stock is losing. For anyone that hasn't noticed, we did a great run up. We had a pretty so-so time for about 4 days, right? For 4 days, Keeve and I did not understand where we were going. So 1, 2, 3, 4, 5. So really, I guess we had 3 days that we didn't like what was happening. 3 days where we didn't understand where things were going. And on that day, we started to protect. And when it broke the 200, all of our positions, our stock positions, had protection back on them. And now we're to the point, if we're going to protect for a loss on our 50-day, a drop back down to our S1 support level, which is just our standard deviation, 1 standard deviation down support level. Now we're going to start, if we see fall through tomorrow, we don't have to double up on everything because we could be wrong, could only follow it for a day, but we're going to sprinkle a couple more long put contracts in there so that our long puts make up more than dollar for dollar than our stocks are losing, which means when we get down around this level, we'll probably take off those extra contracts. And if we keep going down, guess what? We'll put a couple extra contracts back on. If around that S1 support level, we bounce higher again, we'll probably take all of our protection off using past performance, which doesn't guarantee it's going to go back up, but we're going to use that past performance to see if we don't get another bear market bounce. We had a great 3 weeks. It's amazing how quickly you lose 2/3 of those gains. It's just using what we're looking at to be helpful. And the best part about it, big money is already oversold. So people ask, well, Kevin, will it go down to 41.57? Will it go down to 41.15? With earnings coming up, earnings season will dictate how we go. I'm really going to be paying attention to that 42.45, 42.50 level to see if we're going to get a bounce right there. Talking about earnings this week, starting of our banking, we're going to have earnings this week. Went the wrong way. Earnings this week, JP Morgan on Wednesday. Then on Thursday, they're all lined up before Friday when we have our holiday. Citibank, Goldman Sachs, Morgan Stanley, US Bank Corp, Wells Fargo, and United Healthcare. A pretty big stacking up of earnings on Thursday that are bank related. Wednesday, Bed Bath & Beyond, BlackRock, Delta Airlines, Fastenal, and JP Morgan. CarMax on Tuesday. I pay attention to CarMax to get an idea of where Ford's going to be heading. Economic reports. Kind of a crappy week for economic reports. Tuesday, Wednesday, we're going to get CPIs and PPIs. They are our inflation numbers. Guess what? Our inflation numbers are probably going to be higher. So we have a problem here. You want to see days where you'll see a sell-off and a comeback? That's going to be Tuesday, Wednesday. Retail money freaks out. They start to sell off. Institutional money says, you idiots, of course there's higher inflation. You shouldn't surprise you. you'll see a little bit buying back in. Thursday is the big day. Retail sales, business inventories, Michigan sentiment. And if retail sales or business inventories or the Michigan sentiment, if any two of those three are down, we're going to have a big down day on Thursday because no one wants to stay in the market over a 3-day weekend. It'll be a little ugly. So again, that's why we're really looking at adding that extra protection on. All right, information for you guys. Information on how the Fed plans to shrink its balance sheet and what the meeting, the minutes indicated, why it brought our market down last Wednesday. Here's the information for you. Please read through it. It's important. China's smartphone market could plunge 20%, but Apple may still see growth. As Keith and I talked about money to put into place, he's like, you know, my account seems to be a little bit down on Apple. Apple is a great S&P 500 replacement. It runs the S&P 500. It's almost an index replacement, and they pay a dividend. So I told Keith, you know what? If you want to put your account up to 10% on Apple, Apple's an amazing stock that is an index replacement that will mirror the index, yet give you the opportunity for one out of sight 40, 50, 60% year. I did find an interesting article. I can't verify it. I don't know if I believe it because Foxconn makes all their stuff and it doesn't look good. And then really, to understand Warren Buffett's equity allocation is 100% or 90%, do read through the Warren Buffett. It's a really large two-piece article. If you want to see a construction of portfolios from a master that's done ridiculously good almost all the time, this is the raw data, the facts and figures to understand why he's not a bond guy, what years are better than other years, what years he did extremely well versus not extremely well, what years certain percentages of bonds did well and tanked horribly. This is the information if you want to better understand our thought process on why we're not fans of bonds and why we construct portfolios through a Warren Buffett type of strategy. This is where it's at. So pay attention to it. Jim Kohler just noticed, Kevin, you typed it in or you had an autocorrect that was wrong. Should be WFC, I believe. Let's find out. Let's make sure that I'm not saying it wrong. Earnings this week. Wells Fargo, FC, WFC. Way to catch the typo that went to FTC or the autocorrect. Yes, it is Wells Fargo. Warren Buffett's biggest loss in the last 10 years. But please, I'll get this posted tonight. I'll work with Dave Westlake. We'll get this posted. This is great information for you guys to understand our thought process for how we're running portfolios. Any questions? Any questions I can ask you or have you guys ask me, but how am I looking to trade? Currently letting a lot of things run without protection. We need to change that, right? Currently protection on all core holdings, and we started last Tuesday and finished last Wednesday. So any questions you guys have? Jim, I think kind of funny, Jim Kohler got a text meant for Keith today where I complimented him on standing behind and saying, hey, you know what? A good time to sell off Costco. It was a great call on his part that he really pushed for it. And we did it. We did it up at that 307 to 309 price range for Costco. sold out of it so we could book those profits, and we're looking to get back in. And William, yes, I hope this answers your questions for the information up here on how I might say one thing on Monday evening and Tuesday change everything again directly. In all honesty, I hope you guys understand education is theoretical, and what they would do, and there's no stress. In real trading, in real life, it's significantly different. You know, and you hear a lot of time, well, in real trading, you book 20% and then you get into it again. Foolish. Technical analysis says you let things run. I think education contradicts itself so much left and right that it's, to a certain degree, there's really no place for education on the stock market, because there's no place for education in the stock market for someone that's looking for hard set rules that can't make a decision on their own. If you can't make a decision, you should not be in the stock market, and your decision has to come with the most recent data to make your best educated decision, whether you're going to be wrong or right. All right, I don't see any other questions coming in, so guys, have a good one. My night and tomorrow is going to be, again, looking at x-rays and seeing what foot was broken or what wrist was broken or what hand was broken for my youngest boy having a motorcycle accident with his older brother. Bill, I was going to give you a quick call and I missed you today. I apologize. Just watching the market on a down day and kids that are trying to spend more of my money for deductibles for accidents. And yes, if we don't talk to anyone between this week, everyone have a happy Easter. With that said, we might also be shutting down trade findings and adjustments on Thursday, but I will check with Keeve and find out, because typically you're not going to put a trade on right before a 3-day weekend. You will, though. We probably will talk about protection, what we've done for portfolios. So guys, have a good evening. Appreciate it. We're going to make a quick run and see what x-rays tell us. Have a great week, and we look forward to seeing you guys possibly on Thursday. We'll send an announcement out most definitely next Monday. Good evening, guys. Have a good one. Bye-bye.